Hello, this is FreeFX. I'm Francesco Sani, and today we're going to talk about the S&P 500 and bear markets and how we're going to trade this environment. So first of all, we're going to start off with a disclaimer for FreeFX, and then we're going to move on to the actual topic. So here's our disclaimer. Just a quick read through it. Okay, so let's begin with topic of the day, which, as I said, is the S&P 500. And this picture in front of you there is the so-called bear market. Means the financial crash of 2008, the Great Financial Crisis. And you can see I've measured it there, sort of peak to trough. It's about high to low 54% drop. So you can sort of tweak that a little bit because it's a monthly chart. So, but let's say at least 50%. So we tend to define bear markets as 20% drop. So and this was definitely only happened over about 15 months. So this is slow kind of spillover into various markets and didn't just happen overnight. So if you compare that to what happened in the pandemic of 2020, there's your 2020 there. You've got your February and your March, which sort of happened over 2 months, and then it wasn't a 50+% drop. If I do shift and click on trading view, I'll get my measuring tool there, and you can see it's about 21%. So that isn't as severe. It's less than half, and it happened over 2 months, and it was followed by a huge recovery and moving to higher highs to all-time highs. So that's the main difference between the two, is having that sort of scope over time as well. So you can see that we have essentially broken through the midline of the Bollinger Bands. Now, there are different things you can do that. So I've added the blue line there is the weighted moving average, and it's a 21 period. So what I really like about the Bollinger Bands is they define standard deviation, and so they define volatility in a way. So as volatility expands, so do the bands, and you can see that in the narrow area before the 2020 pandemic, and then these expanded, and they have been expanding ever since. As prices got higher and higher, the standard deviation has got wider at the bottom as well. Now, the other thing about this is that we have a drop which is happening over time. So unlike the pandemic one, we are building more momentum in a slower kind of sense. So it's more of a changing environment, as one would sort of shift the bias from kind of long only perhaps to short only. And to kind of illustrate that, I'm just going to show you my portfolio, and this is the analysis of the short versus. They are really quite good. So the shorts are picking up. So we kind of crossed over essentially, and the selling is getting better. And I said that in my previous video, obviously, that the extent to which one can trade remains sort of on both sides, long and short, on an intraday basis. So we kind of obviously gone into a sort of bearish environment, and that means that intraday movements will favor shorts. So if I bring this down to a daily, you'll see deeper retracements down, or rather the retracements up are shorter than the movements down. So if you count the number of candles alone from, say, this point when I've got the mouse, 21st of April, let's go from there. We've got 2 consecutive days down, 1 day up, but it's barely a third of the way of the previous day's price action. Then another deep day down, 2 days up, about 2/3 of the way of the previous, and then another one bringing us down to previous levels, then up, and then 3 solid sort of candles down, and the ups haven't really sort of stopped that trend. But it's even more obvious if we go down to, again, my current operating time frame, which is a 4-hour chart. What's interesting about that as well is if we go back to the monthly, essentially we have the CCI, the Commodity Channel Index, and for that you can see that we've got a deep retracement there, obviously during the pandemic, and then obviously we had this short stint in 2018, and there's another one here in 2016. Now, what's significant about where we're now is that after a long period of nearly 2 years, we essentially come back to the midline of the CCI. So that takes us to a very important point, which is that we may cross that. And historically, if you sort of check where we've been here, it's minus 100 and something. We've not really been down in that territory since the Great Financial Crisis, as I said before. This is on a monthly chart, which is a great way to kind of summarize several years of price action and really get a sense of where we are, the bird's eye view. The Bollinger Bands have expanded quite a bit, so this drop here would have to cover a lot more ground, but obviously the Bollinger Band would follow price action and shrink accordingly. So what we see today is not going to stay this way. It will kind of adjust as we go forward. So it might be nice to, looking back to see if I was right about this, or if this kind of is going to end up looking like this here. I would also say that we have some significant in the weekly chart. Now this is very interesting as well. The weekly chart shows us this picture where we've actually gone negative on the CCI and pressing on the 200 already. Okay. Now, historically, again, if we look back, the pandemic, we went down below the 200 negative and then back up. So we had this rapid expansion of the bands, and here in 2018, it was more gradual. Again, it took a few more periods, and when we got to the minus 200, we picked up. Okay. So scenario one is that we have this as our kind of equivalent, and if you wanted to measure that, this is 2018, and it took about this time 13 weeks, 22%, 13 weeks. We go to where we are now, and obviously we can check if that's also the case. If we go from peak to trough, it's actually 19 bars, okay, and it's about 16% down. So we are sort of roughly in an equivalent situation where it could stop here and start picking up from there. Then we've got something else altogether, which is that the Fed is not finished with this. So although the kind of surprise, I suppose, is over, and everybody knows, I mean, the calendar is all out there. So the next one is the middle of June there, and then we've got July, September, November. All these are going to be rate hikes planned for every meeting from the FOMC. This is not a surprise, but still is going to add pressure, and the money supply essentially into the financial system is going to be curtailed, which means that assets that are overexposed will become more expensive, and basically it will become negative potentially, as the actual returns will be eroded to the point where that money will be best taken into cash and put somewhere else. So what is the next thing that we're going to look at? The next thing we're going to look at is something a little bit different, and that's the commitment of traders report, COT report. So I'm just going to show you that for a second. S&P 500 again, and we're looking at 2 years. This gives us a nice kind of overview of where we've been. And so since kind of just after the pandemic, prices picking up, and the green line here shows a real growth in the asset manager institutional money being reported as longs, net longs into the S&P. then from, you could sort of pin it down to about here, July of last year. There's kind of a decline, and then we have a real decline this year. So we are as low as we were after the pandemic, more or less. So we kind of come full cycle. Another thing as well you can see is not as severe, but you'll see the blue line there, which represents the leveraged funds, and you can see there was some growth, and that growth has declined again. So two sides of the same coin, yes. Going back to my portfolio, as you can see, my Tuesdays more active trades, and the winning trade percentage is 67%. So just to finish, what I want to say was, going back to the S&P 500, I've given you some kind of thoughts about where we might go from here. If we go to the 4 hour, so going back to kind of my current operational time frame, you can see that essentially we've been in bear territory, so under the 0 mark, and we have consistently been there since back here in March, end of March. We kind of turned and we stayed below the middle line of the Bollinger Band, and also we stayed below the midline of the CCI. We've risen above it, and then we've been below it again, and now we've risen above it shortly, just at the beginning of May last week, during the Fed rate decision. But that was just kind of unraveled very quickly, so we're back in bear territory. So we've made progress to the downside, and if you shrink that further, you can see that we haven't been this low for quite some time. Essentially, all of this year, 2022, we're just making new lows in terms of the start of the year. But as you can see, sort of trading to the downside pays off. Now the question is, we've not made real progress since the 9th, since Monday. So I think there is still shorting to be done, and that's kind of for the short term, excuse the pun. So we had to wait and see. So that's kind of to give you a picture of how one can look at the short term, but also take a look at the long term. We looked at weekly, we looked at monthly, we looked at the commitment of traders, we looked at the Fed and the sort of plan for rate hikes, how many meetings there are left, 5. Think about taking a short bias in the direction of the trend, essentially trading intraday in the direction of the trend. And that's kind of what the video is about today. Looking back and seeing previous examples of this kind of price behavior and bearish market, how long that continued, etc., etc. And the final lesson here is to obviously set out to myself, because I had a really bad start to the month with the 2 days before the Fed rate decision, and so try to get into the market and sort of using the usual kind of sense of, here's the technical boundaries and the direction. There was no actual movement in the market that sort of followed through the day, sort of chop around. And so the lesson is that in these transitional periods, as I was showing before on my portfolio, you can see that it's quite difficult to make money sometimes when you're going from a bearish market to a bullish market and vice versa. So, but recognizing that is our job, is to be able to be watchful and know when something isn't working, it's probably because there's a transition. So just to finish, thank you very much for watching. This is my 101st video on FreeFX. It's been a hell of a journey, and I'm really, really grateful for you watching, and I hope this was helpful, and happy trading out there. Hope to see you on my next video. Thank you.